Do you ever feel guilty about the things you buy? Were your sneakers made by underpaid child laborers cranking 14-hour workdays in China? I have that same gross feeling when investing in the S&P 500. I'm not really about the oil or tobacco companies. If you feel guilty about investing in Chinese companies, stay till the end for a handful of funds I recommend, which I have personally invested in. China's economic growth has been roughly double the world average over the past 30 years. Maybe the Chinese Communist Party is partly falsifying those numbers, and GDP is an imperfect measure of economic growth, but China has been skyrocketing for decades. But maybe you don't want to invest in China on moral grounds such as 1, Uyghur genocide, 2, Tibetan, Hong Kong, or Taiwanese subjugation, 3, social credit scores, or 4, you're an American and China is a rival nation. There are also more pragmatic reasons to avoid investing in China, like their water infrastructure issues, which are likely to be exacerbated by global warming and their aging demographics. Today, Relentless Growth will present a few alternative countries to invest in and sample indices you can use to invest in them. Remember, you're responsible for your choices, but I have money in all these funds. In response to Donald Trump's my trade war with China, many companies adopted a China plus one policy to diversify their manufacturing. India has less manufacturing infrastructure than is ideal, but it is growing as people move their business to India instead of China. As a result, India is sometimes described as a pseudo-China for trade since they are right next door and have gigantic populations. India is projected to maintain a more robust age distribution in the coming decades, and the average monthly wage for Indians is only $400 per month. In contrast, in China, it's $1,300 per month. To invest in India, you could buy the iShares MSCI India ETF, ticker symbol YNDA, which holds stock in over 100 large and mid-cap Indian companies. iShares also has an India 50 ETF, ticker INDY, which tracks the 50 largest Indian companies. There's also ticker PIN, the Invesco India ETF. This tracks the FTSE India Quality and Yield Index with modifications that give it a high dividend yield. Partly from that same China plus one policy, Vietnam's manufacturing has grown over 360% over the past 9 years alone. Vietnam's average worker earns $275 per month. Specifically for factory workers, as of 2020, China pays $6.50 on average per hour, whereas Vietnam pays $3 per hour. That means you could expect Vietnamese labor costs to be half of China's. You can use VanEck Vector's Vietnam ETF, ticker VNM, to invest in Vietnam. This fund tracks roughly the 50 largest Vietnamese companies, ensuring that no one company takes up more than 8% of the index. Mexico is the only country on this list not to share a border with China. Instead, it shares a border with the United States, which is still the largest economy in the world by most metrics. Since the U.S. views China as a rival and Mexico is right next door, the average Mexican worker's salary of $580 a month is likely to be very enticing, even compared to Vietnam and India, since shipping costs would also be lower. It also helps that the U.S. has active and accelerating efforts to work with the Mexican government to quell their organized crime problem as part of the war on drugs. One way to invest in Mexico is the iShares MSCI Mexico Investable Market Fund, ticker EWW. This fund is built to dabble in various Mexican companies and has grown over 7 times its original value since 1999. Alternatively, you could invest in ILF, the iShares Latin America 40 ETF, which tracks the 40 largest companies in Latin America, with Mexico being its second largest stock source. You do not have to feel guilty about investing. While you can also look up these stocks yourself, my M1 Finance link below has pre-built pies of the emerging and foreign markets I'm investing in. You only have one life to live. Grow it relentlessly.